Welcome back to Keith Talks, guys. My name is Keith, and in this channel, we talk about everything investment related, from stocks to cryptos and beyond. So let's talk. So a lot of people, when they want to research a stock, what they'll do is they'll go onto Google, a search engine, or Bing or Yahoo, and then they'll start searching up a stock, and then they'll start reading articles about what the future of a stock might be or what someone else is saying. Maybe they'll go onto YouTube and search a YouTuber and see what the YouTuber is saying so they can pick a stock. So a lot of people, this is what research consists of. And unfortunately, that's not good enough. That's not the first thing that you should be doing, because what you're doing is essentially you're just chasing hype. So what should you really be doing is you should be looking at the numbers. So the question is, how do you look at the numbers? Because a lot of people out there are actually giving out incorrect information on what kind of numbers to look at. A lot of people are saying, oh, look, this car company like Lucid is going to, sell 50,000 cars next year. Therefore, that's this much money. That's why I'm going to pay, like this much dollars for this share. But that's actually a terrible, terrible, terrible way of picking a stock. What you actually instead should be doing is looking at the numbers. When I say looking at the numbers, I mean you should go to the company filing and read their annual report. Well, how do you do this? Right? Well, there's a website called sec.gov. It's the SEC's website. You can go there. There's something called Edgar Search. I'll leave a link in the description below. It's free to use for everybody. When you go on to Edgar Search, you can search the ticker symbol of the stock that you want to look up, and you can just look for something like the 10K or the 10 cube. When you open that document up, it will show you the numbers that you actually need to see. And from these numbers, you can actually make a conclusion on whether you should be looking into the stock or not. Now, reading the balance sheet is really, really important. Looking at revenue growth is really, really important. And looking at share dilution is also really, really important. Those are basically three big bubbles, I like to call, that I look after when I'm looking at a stock. Revenue growth, is there any dilution, and how's the balance sheet looking? Because from the balance sheet, you can actually find a lot of numbers like your liquidation value and other important information, like what's the 5-year return on the capital in this company, right? Is it higher than 10%? Because if it is, then that's a really, really great thing. Even if the company is not profitable yet, are they actually increasing their profit? Meaning, like, if they made negative $400 million 3 years ago, then 2 years ago, did they make negative 200 million? Last year, did they make negative 100 million? This year, did they make negative 50 million? Because that's increasing, right? That means the company is doing well and better and better. Is that happening? What is the trend? Just by looking at the numbers, you can literally see, oh, wow, this company is actually doing well, or this company is not doing well. And then using those numbers, you can make just small calculations to see how they might do in the future, or what the value of the company is right now. These are the kinds of things that will give you conviction to really believe in the company's numbers, because any good business should have great numbers. A lot of businesses who don't, they might be extremely overvalued in price, and it's hard to tell that, because when it comes down to picking a fair value for a stock, there's a lot of things that end up being subjective. Like, some people will consider goodwill not to be an intangible asset, well, even though it is, but it's a very, very subjective matter. And a lot of people will look at different things and then they'll say, no, it should be worth more. That's why I consider giving a fair value to a stock to be a very subjective thing. At the same time, it's something important that you should do, because those are the things that actually give you conviction when you're trying to pick a stock in the first place. Now, I have a list of 13 things that I look at. Now, the list that I have that I'm looking at does change here and there, and sometimes I add to it or sometimes I take away from it, depending on what's actually working for me and what's not working for me. So as time progresses, this list, is slowly starting to change. But right now, it's about a list of 13 things. So here it is. So the first thing is the market cap. I don't like picking stocks with tiny, tiny market caps, like penny stocks. Not that you can't make a lot of money with penny stocks, you can, but it's just I've been burned in the past, because, I find a good stock and I think it's trading below what it should be trading at. I buy it, and then literally like 3 days later, they just dilute the company like crazy, even though they haven't, diluted as much before in the past. And that, of course, burnt me. So I just like picking stocks with large market caps. The second thing is picking stocks with a pretty good PE ratio. I like to stick with 25 or less. I know with tech stocks, sometimes it can be bigger, the PE ratio, especially if the company's a mid-sized stock. Then you're going to see a lot of companies that make only like $800 million or $1 billion that have a PE of like, over 50 or maybe even 100. But here's the thing, that just like PEs, price to earnings ratios, only show like valuation, right? And the thing is, those smaller companies have higher valuations, but as they get bigger and bigger and bigger, the PE tends to usually, get smaller and smaller and smaller. And it is pretty difficult to figure out how much money or revenue a mid-cap company is definitely going to make, because I've seen a lot of mid-cap companies that are only making like $1 billion this year. All of a sudden they make $7 billion next year or $8 billion next year. That's usually why they have such a high PE ratio. And it just usually keeps going up. So of course, whatever you decide to become an expert in, you just have to focus on that. Or that's what I usually do. Like if I'm going to pick mid-cap stocks or large-cap stocks, and I just want to focus on one field. I don't want to do a small cap, a big cap, and this and that, because then I'm all over the place, and I don't really have like an understanding of a specific market or a specific type of niche in my investing style. And instead, I'm just kind of all over the place, and then I might take something I learned here and then try to put it there, and it won't work, and I'll end up getting burned, which is not a good thing. That's not what you really want to do. So the third thing is I assess the PS ratio. Now, price to sales ratio for me is really, really important. I really like to see how much money the company is making in comparison to their market cap. That's pretty much what the PS ratio shows. And usually like a standard PS ratio is 4 to 7, but in tech stocks, they're much higher, especially for the mid-cap stock range. Larger companies like the mega large companies like Facebook, they're of course going to be, very low. They're not going to be over 10. They're going to usually be 10 or less. The fourth thing I like to look at is the 5-year return on capital. I want to make sure that's a pretty high number or a pretty high percentage. Because if they have a high percentage, that means that they're actually using the money that they're making in a good way. And that just shows me confidence that the company kind of knows what they're doing. And then I can assume based on that the following year is also going to be the same thing, or if anything, it's going to be better, which means that's definitely a stock that I should be looking into further. Now, the fifth thing I look at is like whether the company has dividends or not. I'm not a huge fan of stocks that pay dividends. I know Apple stock has dividends, and a lot of people are huge fans on, writing covered calls and cash secured puts on like Apple stock, and it pays a dividend. But that's like a different investing style. If you're just looking for like appreciation, then I'm not really a big fan of dividends, because usually when a company pays dividends, that typically means that they have too much money and they don't really know how to spend it on innovation and growth. And that kind of turns me away from the stock. But again, that's just a personal thing. That doesn't mean that's not a good stock, or it doesn't mean it's not an undervalued stock or anything like that at all. It's just personal preferences. So that is one thing that I also take into account. The sixth thing I look at is the revenue growth. Is it consistent, right, in the last few years? If the company's only been around for 2 years, then usually they have or 2 or 3 years, then they usually have like a PDF, somewhere online. You can find this on sec.gov too, and then it'll tell you like how much they made before they IPO'd for like the 2 or 3 years that they were around, and then you can kind of get an idea of whether the revenue has been growing consistently or not. And usually these mid stock companies or smaller cap companies, they do grow dramatically in the early stages, but then at a certain point they start to plateau, and their growth in percentage is much smaller, but in dollar value it's obviously much greater. But basically what I'm looking for there is it growing? That's what I want to know. Is it growing, and is it growing by a large percentage? Based on how much it's growing, can I assume that it's going to continue to grow next year, the following year? I'm not really the type of person who's going to buy a stock and hold it for 25 years. That's not what I'm going to do, right? I'm going to buy a stock and I'm going to try to give it a price, and then I'm going to try to find a sell price for like a target to when I can sell the stock, and then I'm going to hold it for a certain period of time, maybe a year and a half, maybe 2 years, maybe a little bit less, pretty much until the stock hits the price. Now, the seventh thing I look at is profit growth. So is the profit growing consistently? I mentioned this earlier. It's the same thing as revenue growth. I just want to see if it's growing or not. Now, the eighth thing I look at is something called the liquidation value. So basically what I'm doing is, on the balance sheet, you can see what all of the assets are. So I take all of the assets, and then I pretty much try to get rid of something called the intangible assets. So intangible assets are when a company is making money, but then they have money that they're owed, but they haven't received yet by the customers because, they sold something, maybe a subscription base, and then they're just adding how much money they are supposed to get. But then they don't actually have it yet. So then I just kind of subtract that money out. Sometimes it could be intellectual property. It might be goodwill. It could be anything, right? So some things I do have my own personal opinions on, and I might say, no, even though that is an intangible asset, I don't really consider that to be something that I should deduct for my total assets, but then I'll do my own, it's kind of subjective, and I'll make my own opinions on it, and then based on that, I'll divide that by the total number of outstanding shares, and then I'll get a liquidation value price. So if the stock price is trading below that value, that means it's super undervalued. It's kind of like saying it's a Warren Buffett stock. You can buy like 50 cents for $1. For example, if the liquidation value is like $10 and the stock is trading at $5, then there you go, the dollar trading for 50 cents. Now, another thing I do look at is dilution. Like I said earlier, I got burned before by dilution, and I learned the hard way, and I made sure to never make that mistake again. Like a lot of the things that I have on my list is just from personal experience. Some things from books, some things from personal experience, some things from other YouTubers, and a podcast, a lot from podcasts actually. Share dilution, basically it's like when you have a large pizza, let's say the pizza box is $10 and each slice is $1, but then let's say somebody sticks another 10 slices in there. Now you have 20 slices, but the box is still worth $10. Well, guess what? Each slice is only 50 cents. So if you originally owned one slice and it was worth $1, well, now it's worth 50 cents. So even though the price of the pizza box didn't change, the slice significantly went down because there's more of them. So you own less of the pie. In relation, the pizza box itself is the market cap of a company, and the slice is the share that you own in the stock. So that is something I'm always careful about nowadays. Number 10 is I like to look at the free cash flow. You can Google it, you can calculate it yourself, and just see, how is it? Do they have enough cash to pay off their debts? If they don't, well, are they going to be able to do that soon in the future? Because if they're going on the right trajectory, then it might be okay. That's also something I like to glance at on the balance sheet. And then, of course, number 11, I assess the free cash flow, right? How are they using it? And by reading the actual 10Ks and 8Ks, I know it's a lot of information there. It looks like it's very, very dense, but then when you read through it, you can actually learn a lot. It'll tell you where the company's actually spending the money, what are they actually doing with the money. So those kind of things will give you a much better understanding. Not just that, but when you actually read the information about the company and everything, and you start to understand how they actually run their business. This is not information you can just find on YouTube or anywhere else. You just kind of have to go to the source and sit down and just spend like an hour reading the actual entire filing. And number 12 is I assess the company. Like overall, after learning about the company a little bit, do I have conviction? Do I love this company? Just because it's trading below what I think it should be trading, do I still feel comfortable buying it? Because even though the price is low, I might not be a fan of that industry, or maybe there's something about that stock that bothers me a lot that I don't want to buy it. Because if I feel some type of way about a stock, well, guess what's going to happen? If it dips more, instead of having conviction to buy more, what am I going to do? I'm going to sell because I didn't like the stock in the first place, right? It's not just about numbers. There's a lot of other factors that you want to be looking at too. So that's where you actually want to research about the company, see how are they running the business, right? When you looking at numbers is important, but then also looking at the business itself is important. And this is why it's important to actually read the SEC filing. And of course, I like to make comparisons to the market cap. Like I mentioned before, like the PS ratio is 1. Another thing I like to do is take the free cash flow and then see how much more is it trading compared to the market cap. And I do the same thing with the profit that they're making. And then just based on these numbers, I compare it to its competitors. So that's what I do for step number 13. Take all your numbers that you have and then compare it to all of its other competitors, and then see where they're standing in comparison to their competitors. And is it worth it? Is it really worth it? If they're trading much higher than than their competitors, then why? Right? Does it mean they're overvalued, or is it just because they're doing much better and they own more of the market share? Because a lot of companies, they just own more of the market share, and that's why they're very popular. Anyways, I hope this video really gave you guys an introductory view into how you should be really looking at a stock and what kind of things that I look at. I really hope that helped you guys a lot. Thank you guys so much for watching this video. I really do appreciate it. My goal in this channel is to reach 1,000 subscribers. So please, it would be a great favor for me if you can hit that subscribe button, smash that like button, and hit that notification bell. Thank you guys so much for watching, and take care.